Welcome to the YouTube replay from our virtual Green Drinks November edition. For this edition, we welcome Tina Kraus from Answer It, John Hastings from RBC, Aaron Thornell from OREC and Co-Energy, and Mark Goldgrub from Green Economy Law. Enjoy this replay.
So everyone, welcome to Green Drinks Ottawa. Of course, as we mentioned, because of the pandemic, in April, we moved over to a virtual platform which has worked out very well for us because it has allowed us to bring in people from other parts of the country. So we've got some people that are from Manitoba tonight, from Alberta, we've got Toronto, Peterborough, Milton, and we've got some people from the States. Not sure if they're on, I have to check, but so it has allowed us to spread the word and get people more into Ottawa and find out what we're doing. So it's great. And usually we have people from Kingston, Smith Falls. So it's awesome because there's also other green drinks that have canceled their physical events, but have not gone virtual. So we have invited them to come to the Ottawa Green Drinks and share that with us. So for those of you who don't know me, my name is Raymond Lemire, and along with my colleague Nick Hebb, we work at Smart Net Alliance. So the Alliance is a group of businesses and organizations who share the same values of sustainability, and we collaborate on projects and initiatives to accelerate Canada's transition to a sustainable economy. If you want more information, you can go to www.smartnetalliance.ca, and Nick will put that link in the chat box if he hasn't already done so. So you can find our membership directory. You can, if you're interested in being a member, we have a small online course that is, are you a good fit? You can go through that and see if you're a fit, and then we have the application form online. And looking at the member profiles also will give you an idea of what types of people that are in our organization. So those of you who are not familiar with Green Drinks, it is an international event that is usually done in about 500 countries in, sorry, my phone just went off, 500 countries across worldwide. And there's about 20 chapters in Ontario. In Ottawa, it's been going on for at least 10 years, if not more, people tell me. Smart Net Alliance has been involved for about 5 to 6 years. So we've been hosting it, and that's where we brought in the speakers and a little bit more structure, registrations, whatever, just to make it a little more formal and organized. As Nick noted, we do record at the Green Drinks, and then Nick puts out the link on our YouTube, and he'll put it out on Facebook, and we usually put it out in the newsletter so that people can actually listen to it, or if you want to forward it to somebody else, that's awesome. So after tonight's presentation, we'll do questions and answers. If you want, you can put your questions in the chat box, and Nick and I will monitor that, and then we'll have our Q&A session at the end. Tonight, we are focusing on responsible investing. We have 4 guest speakers, 2 of which are SNA members. So these are Tina Kraus, she's CEO and founder of Answer It. John Hastings, investment advisor and portfolio manager with RBC Wealth Management. SNA affiliate member, Aaron Thornell. He's the acting general manager for the Ottawa Renewable Energy Co-op and Co-Energy Ontario Cooperative. And then we have SNA member, Mark Goldgrub, who's the founder and lawyer at Green Economy Law. So in a moment, Nick will introduce the speakers individually, and they will then go ahead and do the presentation. Again, questions in the chat box. We're recording, and we'll put the recording on YouTube in a few weeks. And Nick, it's back to you. It's all yours.
Thanks so much, Raymond. A great way to start things off, and I want to say a big thank you to all the speakers. So we'll go through each speaker session. There'll be a bit of time at the end of each speaker for some short Q&A. So if people have some questions, always put it into chat throughout, but we'll take a few questions after each speaker. Then after all the presentations, we'll go a little bit deeper on a bit there, and then go from there. So to start things off, we'll throw it over to Tina Kraus, who is the CEO and founder of Answer It, and she's going to give us a little bit of a rundown generally on what responsible investing is. I know it's something that I've been kind of scratching my head about for the last couple of years. You know, everyone's got these RRSPs and wants to invest, and we see these ESG indexes and what's all that. So each of the speakers will be able to demystify that a little bit and go a little bit deeper. So for Tina, she is the founder of, we said, Answer It, and that's a platform of decision-making tools for government, foundations, and the nonprofit sector. She's an innovator and doer, which is great. That's what we look for at Green Drinks. And her recent lists of accomplishments include several firsts. For the past 3 years, she's been involved in tech startups and expanding her funding and business knowledge in the tech for good sector. And she has continued to coach in social enterprise and social finance, furthering her knowledge of 10 plus years in the sector. So Tina, come on over, and we'll get you to, we'll share your screen here in a sec, and we'll get your slides going. Give me a sec for that.
Great, thanks very much, Nick.
Tina, you wanted to do the polls. I've set them up, so just let me know when you want to do them, okay?
Yeah, why don't we do them right now, Reno?
So
yeah.
Tina,
Yeah.
it's telling me since I'm logged into a different device, my polling session is inactive, which is not good. Crazy. I don't know, because I'm at home, so I did the polls at the office. Now I'm at home. I'm not sure
if
why
I can get the polls going. I just want to get Tina's.
There we go.
There we go. So
polls
they're
are
coming up there. So polls are up, and
Okay.
we'll get Tina's presentation going here. All the fun technical stuff.
Thanks very much. Okay, there we go. I'm gonna put my screen up. And if everyone can just take a minute to do the polls, it gives us a good idea about the audience, help us gear our talking points, and a little way for us to know who's out there in virtual land. Nick, can you let me know when that comes
Apparently Mark Goldrub is not in control of the polls.
Apparently I'm in control of it.
I have no idea
that works
how that
perfectly.
has happened.
We've got the lawyer in charge of the polls, so I trust that. It's a bit like the Oscars with the briefcase.
It's just
And the first
the millennial. It just found the millennial. And
do we know how long we went? Did we go 2 minutes on each poll, or?
I'd say a minute.
I have an end poll button.
Yeah,
Yep.
so do I as well. So we'll give it another 30 seconds, everybody. We've got quite a few coming in. So it's great. Keep the answers rolling in, and then we'll tabulate the results.
And
It's funny that I can't see the poll.
Thank you so much for everybody being on and even participating in the poll. I have a number of friends who are on tonight. I was checking the attendees. I want to give a little shout out to Henry Wellish, who is 94, 95. And Henry was a self-taught investor for a number of years. And through his daughter, Susan, a friend of mine, he's now looking at responsible investing and impact investing and checking it out. So yeah, let's all be there when we're a little bit older, doing these fun, great things and getting
I'm just
online.
closing the poll now, Tina, and
Yep.
we've got 30 people responded, so that's great. 78% for those analytical people, and the winner was have you invested and through a traditional advisor, so that was 37%, followed by a certified responsible investment advisor with 23%.
Nice.
Oh, I'm sorry, on your own was the second, and the certified was third, so that's great. Thanks
Very
everybody
cool.
for answering that.
Mm-hmm. Okay, so I guess we should get started with my presentation. Thank you so much again for everybody getting on. I've had the opportunity here to, I just have to remove the poll from the middle of my screen so I can see what I'm doing. Sorry, 1 second. So.
That's the fun of these polls, right?
And it's funny, I have to stop sharing my screen in order to get rid of the poll. So terribly sorry. Gonna go back now to the presentation. So yeah, thank you very much for inviting me and letting me speak tonight. I am handling the introduction. I'm going to be followed by, on the panel, by 3 great, very good men who are specialists in their field, who are going to be able to go a lot more in depth than what I can do. So I titled this introduction, Investing in the Good We Want to See. I am a responsible and impact investor. I have been since 2006, but my day job is, as mentioned, as the CEO of Answer It, which is a tech for good platform. The way I learned my investing, though, actually, was that I had the opportunity to have a couple of radio shows and do a number of things in the social finance field. So in 2011, I had SoFi in Canada, which is the here, see, click of social finance. And then from the information I did, about 120 interviews, I decided to try to make a film called Skirts, Canadian Women in Social Finance. Didn't work, didn't get the money for the film, but what I did get to do was create the Women in Impact Investing Awards in 2014 at Mars in Toronto. So following that, 2016, I started a radio show. CKCU FM was here in Toronto, here in Ottawa. And that morphed into my podcast, Buy Some Good. And for the last year or so, I've actually been writing a book on women in social finance in Canada. So basically, I learned an awful lot about investing from the people who were doing it, people who were the first in Canada to create circumstances where many of us can now invest in the things that are of interest to us. So I wanted to do a little bit in terms of definitions and really to say very simply that many of us have come to understand that we need to put our money towards things we value. And when we do it, and it's just us doing it on ourselves, on our own, or directed through a certified responsible investment advisor, we're called retail investors, meaning individuals that are directing where their money goes. This is different from accredited investors, and I'm sure some of the fellows following me will be able to go into that, but I'm specifically talking to us, individuals, retail investors tonight. So I wanted to use this slide to reinforce for people who are new to the field that investment's not charity. It is definitely 2 different things, although the sentiments are often similar. But with the social investment, we are it's definitely a requirement that we're investing with a financial return, the expectation of financial return. And then we'd also like to see things that have to do with social, governance, environment, some improvements or support. Some stocks or some funds that are working in this area. So along with that expectation of financial return, that we would assume that there will be increases, and those increases can happen over time. The money gets returned at maturation in terms of bonds, etc. So this is a very different activity as compared to charitable donations, where you're donating the money, you're not going to have any return, the money's not going to be given back to you. You will have a tax receipt with some possible tax benefits, some implications of that. But basically, for charitable giving, you are just giving the money over to the program, over to the organization to fulfill their programming. Whereas with investments, investment does mean financial returns, along with the social good that we would like to see. So there are 3 tenets of responsible investing, and that is environmental, social, and governance. And for people who are interested in this field, what we do is we align our investments with our own personal values. There's 3 approaches. So the first one is social investing, which is exclusion. This is the first type of investing, began in the 80s with Michael Jansky, where people would determine they didn't want their money to go into weapons or tobacco or something along that line. And so they had a strategy which meant that when their advisors, when they were looking to choose stocks or bonds, they were keeping their money away from something, excluding certain companies and investments. For responsible investing, there was the next wave, and it was about inclusion, where people wanted to put their money towards things that they wanted to support. So this began the types of social investments where people were starting to look at how did companies operate. Did they treat their workforce well? Do they have some diversity, which is very on trend right now, where we're asking companies to improve their diversity. And when we invest in them, we're indicating that that is what we want them to continue to do. And that is responsible investing and inclusion. For impact investing, this is the most recent wave. The actual term didn't exist. Really, it wasn't in the vernacular till about 2013, 2014. And impact investing was putting our money towards change. So the things we wanted to see change or happen. Obviously, responsible investing and impact investing are very close because when you're including certain stocks or funds that you're interested in, you can then see that some of them have movement. And so impact would be seeing plastic cleanup, seeing water improvement, seeing wind energy further developed. Those would all be types of impact investing. And we measure the success of those investments, not just on how much money they return, but as I said, with measurements on their environmental, social, and governance impacts. So as individuals in responsible investing and impact investing, there's actually only two ways forward. One is to invest on your own, learning about stocks and the bonds and funds and various things that you'd be interested in. And the other one is with a responsible investment advisor. So going to the second part, with an advisor, if you go to the Responsible Investment Association, they have over 400 people who are certified in ESG work. And most of them, though, do work for investment companies or banks, etc. So sometimes you will still see similar products to what you're used to with traditional investing, because the banker and the investment firm says, we have this environmental fund, we have this, something along that line. And so you may appreciate that level of expertise and that specificity, or you can take the time to become an investor on your own. So the way to approach that actually is to start out with a strategy. And a strategy does not have to be reams and reams of printouts or big Excel sheets. The strategy really is a list of guidelines, principles, or things that you believe in that you would like to put your money towards. The reason that you should have a strategy before you start doing any investing is there's a level of due diligence that we have to do in responsible investing that checks companies, stocks, bonds, or funds against the things that we believe in. And each investor is different in their strategies. There's things that they would emphasize that others may not. So for example, particularly in the funds, there are a number of funds around the world. This the impact investing sector has been just skyrocketing, particularly in the last 5 years, incredibly well this year. But when you look at the funds, there's actually individual holdings of companies in each fund. And if you were somebody who had a strategy that you personally really support the ban on plastics, so you don't want anything to do with plastics. Some of the ESG funds inside their holdings, they have companies like Johnson & Johnson, Procter & Gamble. according to certain metrics, these companies they're making great contributions towards ESG. But for you, within your own strategy, if you do not want to support companies that create plastics and pollution and whatnot, you probably wouldn't want to be in that fund. Even if it is certified and well-regulated and is doing what it says it will do, it wouldn't be the right fund for you to be investing in. So this due diligence element often feels intimidating to people. They get very scared about it and whatnot. It's not a scary thing. It's you doing your own research. And most of us do that. We do that now when we shop online. We look at reviews. We see what companies are doing. We talk to our friends. Although there are definitely very specific ways to approach due diligence when you're looking at stocks and things, you can learn to do that for free online. There are many, many individuals, organizations who teach due diligence if you want to drill down really specifically on the numbers. And I do encourage that for people who are looking to invest in individual stocks. But of course, as impact investors and socially responsible investors, we want to see the value in the social improvements, the environmental improvements, et cetera, the things that make our communities, our society stronger, and have strong companies with good financials and the ability to return our money and more, because that is the investment, those two things together, the creating wealth and doing the good that we want to see in society. So this is my last slide in the introduction about gaining and losing money. If you make investments, it is standard that while you will gain money, you will also lose money. It doesn't work any other way. Nobody gains continuously without ever having a loss. The things people say about Warren Buffett and whatnot, yes, genius investor man, but guaranteed that he's had losses as well. And so you take the good with the bad and you prepare for that. But the best part of doing this kind of work is that you're going to make more gains than you're going to lose. And those gains will be money returned to you, the money that you invested, and also the improvements in society that we all want to see. These things are not exclusive anymore. And that's why we have the opportunity to do responsible investing and impact investing to highlight our own personal values and make the world that great place that we want it to be. So thank you very much. I'm going to now turn this over to my other panelists who are going to do a very good job at taking you deeper into some of the things that I mentioned.
That's great, Tina, and we'll open it up for a couple questions just before we move on to the next one. But great presentation. Nice to hear sort of demystify some of those things. And I'm sitting at the Impact Hub, and I had a Beyond Meat burger earlier, so I hit a couple of good ones. I just need to add Tesla onto there, and then I'll be good. So we did have one question from Anatoly. He's wondering, how can an quote-unquote advisor also work at a bank at the same time? I know a lot of people are wondering that. Is there some sort of rules around that, or how does that work?
Well, interestingly, I'm not sure who's coming right behind me, whether it's John or Aaron, but John is a certified financial advisor, and he works for RBC. So that might be, John might be covering that in his presentation. But those advisors took additional certification so that they could assist people in looking at environmental or social governance impacts in the stocks or the funds that they were presenting. Now, a lot of banks and investment firms have been developing funds because there's been such a big uptick. There's been so much money put into the sector recently, and it's just going to increase. But now we have people who are even more experienced in traditional investing and this type of investing who can help us make those choices. So if I answered that wrong, John, please jump in and do the correction for me.
Yeah, there we go. Thanks so much, Tina. Anybody have any other questions while we have Tina up? I do want to segue over to John shortly here, but just wanted to take a look, and we'll circle back for a little bit of a deeper discussion at the end of the presentations as well. So that's probably a good time to bring in John. I want to thank John so much for taking some time to join us. John Hastings is an investment advisor and associate portfolio manager with RBC Dominion Securities, and he's been helping his clients invest for a sustainable future. John has been at the forefront of the responsible investing movement, and given his experience as a former member of the Canadian National Kayak Team, good job, John. Have to get some kayak tips.
Thank you.
He's focused on finding solutions for climate change, obviously, because we won't be able to kayak a dry planet. So John is also a CFA charter holder and holds an MBA from the Tefler School of Management. So come on in, John. I know you've got your screen shared there, and we'll send it over to you for your presentation.
First off, everyone can hear me okay?
Yeah, I'm getting you.
Perfect. So Tina, thank you very much for the I guess the briefing on responsible investing and what it is, and giving some insight into it. So what I was hoping to do in my very short 15 minutes tonight is to sort of talk a little bit about what responsible investing is, why it's relevant, and mostly how we're, some of the myths around responsible investing and how I'm integrating it into the wealth management process. But before I get going in there, just a quick background on who I am and how I got into this. So as Nick had mentioned, I was a member of the National Kayak Team for a number of years, and through this journey, I witnessed firsthand the impact of climate change on the rivers I raced and the communities I visited. And so initially I took to the advocacy road, and given my stature in the national team sort of ranking, I was able to kind of jump on with a couple of great organizations and speak about, climate change and what I'm witnessing firsthand and so forth. But it didn't really resonate with a whole lot of folks. People got excited about it. But what I realized very quickly, especially given my background in commerce and in my schooling and education, I realized money is a more powerful driver. And I developed this thesis that, there's a number of companies out there doing great. And I think they're going to have a really long sort of, great financial sort of opportunities and a great performance. So I'm sure there'd be a lot of other people that want to, look at investing alongside me in these companies that are trying to address some of our, greatest societal and environmental challenges. So I jumped on with RBC Wealth Management and sort of, 7 years ago, I started doing this, and it's been just an incredible experience and ride, and to see the growth in the space has been just fantastic. So what is responsible investing? I mean, I don't want to deliberate too long on this because Tina's already done a great job sort of explaining it, but we really look at responsible investing as sort of an umbrella that integrates either, socially responsible investing, ESG integration, impact investing. And so when we really look at these 3-4 kind of areas, or the spectrum that I like to call it, we have SRI, or socially responsible investing, which Tina had sort of alluded to as kind of where it all started back in the 70s and 80s, where folks were trying to avoid investing in particular sectors or countries and so forth. And so really, what we're doing is we're just excluding companies and sectors, right? Then we sort of looked at thematic investing. We're trying to invest in specific issues, and pertinent to this audience tonight, climate change is one of those themes that we're all trying to address and invest our money towards those solutions, right? So it's a very focused strategy. The other area is ESG integration, and this is huge. And so ESG integration is sort of what's kind of seeing a significant amount of fund flows coming into it this year. And really what we're trying to do is saying, okay, well, you know what, we're trying to assess companies on their environmental, social, and governance risk attributes. We know those who are not so great, but keeping those that are great. And the thesis here is that, well, over time, these will provide, stronger performance, but also more importantly, reduce risk. Because if logically, if you're a company or you're an organization that's sort of addressing some of these risks that aren't necessarily reflected on the balance sheets or financial statements of their financial statements, what you're doing is you're able to sort of, hedge or mitigate things that just might pop up, which we've seen over the last few years. And finally, impact investing, which is a growing space for sure, especially on the private side. So, when investing in private companies and private funds and so forth, there's some growth in public equities as well. Some great examples of great companies out there. But the issue that we're starting to see is with data and sort of understanding, okay, well, is company A, B, C, or D actually driving impact? It's very simple to sort of see their financial metrics and returns. That's very clear, but how do we measure impact? And that's an area that's receiving a lot of attention these days. So in terms of assets into each of these strategies, I mean, the biggest is, well, apologies for this chart here, but the biggest is ESG integration and socially responsible investing. And that's simply because, well, socially responsible investing has been around the longest. ESG, obviously, or ESG integration is obviously growing leaps and bounds. And I really relate it to the simplicity it takes to actually integrate these strategies, meaning ESG integration, you know, there's data that's provided by various providers, Sustainalytics, MSCI, FTSE, and so forth. That help investors, help portfolio managers sort of assess the risk attributes associated with the company. So it's easy to kind of say, okay, this company has great financial metrics and numbers and great performance and great long-term prospects, and as well they have strong ESG sort of attributes, right? And SRI, I mean, this is really straightforward. It's saying, oh, I want to be fossil fuel free. Well, I'm just going to exclude, you know, fossil fuel companies from my portfolio, right? So it's easy to kind of make those changes. You know, when we get into thematic and impact and positive screening and sustainability themed investing, that requires a little bit more energy and thought because, you know, the universe is somewhat constrained, and trying to identify and find those companies requires a little bit more work. So why is responsible investing relevant today? And I think the biggest piece here is that it's growing like crazy. So if you don't know about responsible investing and the spectrum of opportunities and areas, I mean, you're missing out, right? And I know this audience I'm speaking to is very well versed and very interested in trying to drive change, especially in the environmental lens. So this isn't anything new to you. But I think the most important thing is that there are a growing number of societal and environmental challenges, and government just really doesn't have the resources to control this. So this really relies on companies to be, you know, greater champions in their communities, greater champions to the stakeholders that they, you know, that they have, and really addressing some of these challenges. But I think more importantly, what we're starting to see, and this is what I witnessed when I was kayaking, is the notion that there's great business to be had here addressing some of these challenges, right? So, I mean, this is where corporations step up, and this is where, you know, helping these companies and identifying those that are actually steering change in a positive manner, you know, is not only going to help our society, our environment, but also it's good business. It's good business practice. So that's why it's relevant today. And there's more to the story as well, but I'll leave it there. So myths around responsible investing, and I think the biggest one has always been around that you're sacrificing returns versus responsible investing. And this is something that's been proven time and time again isn't necessarily true. I sent an article to Nick earlier today, and I don't know if he's able to share it to the chat because I realize you can just share links to stuff. But this is from RBC Global Asset Management, and they did a white paper where they actually reviewed, and I think you could probably access it through their website if you're so inclined. But they did a website, or they did a research where they reviewed all these journal articles and so forth from these incredible scholars and academics and organizations. And really what they found is that, well, responsible investing, and mostly just looking at ESG stuff, or ESG integration, because it's easy to monitor and track, it actually provides a little bit of greater alpha. So think of it this way. If you're invested in the S&P 500, and then you have an S&P 500 that has ESG integration attached to it, you actually generate greater return than you would just using the standard benchmark, right? But the other thing that came out of this white paper is the reality that you reduce volatility, you reduce risks. And I think that's aligned with the fact that, well, a lot of companies these days, their value is mostly intangible, right? So think of the brand and the goodwill that's associated with the company that we own and that we invest in. Versus say 20, 30 years ago, where most of that value is a hard tangible good. So, you know, the warehouse, the mechanics, the equipment, so forth, right? So if a value is derived from intangibles, that means that, you know, if something bad happens or a company's a bad actor and their brand suffers, well, the value of that company is going to suffer as well, right? So all that to say is that, well, it makes a lot of sense that if you have a company that has strong ESG attributes, well, it's not for sure, it's not certain by any means, but you can kind of see the logic here in the sense that, yeah, you know what, we're going to protect ourselves from the downside here. So we're going to see a little bit less risk, less volatility. The other myth too that is completely wrong, and Tina had sort of alluded to this in her presentation as well, is that there aren't as many products available. I mean, this was sort of true a few years ago, when you could only find SRI. I mean, when I first put the sign on my door saying I'm open for business, I mean, it was great for me. It was great for business because people were coming to me saying, listen, I want to invest in a portfolio of companies that are fossil fuel free. and there weren't any products out there, right? It was very limited. But now you can find mutual funds and ETFs globally in Canada that are fossil fuel free, right? You can find ETFs and mutual funds that, you know, look at other sort of issues. So for instance, climate change being one. You know, sustainability, low carbon, and I know Mark had some great slides on low carbon and some discussion points there. But the reality is that there's a lot more product than meets the eye. And so most of the time, especially if you're working with an advisor, and I saw that poll, and thank you, Tina, for putting that out. I mean, most of you who are investing are working with an advisor of some degree. Get them to work a little harder for you, because guess what? There are products that can meet your specific needs and interests. And for those of you who have group plans, you know, there's likely a lineup of solutions or products that can, you know, meet your specific missions and values and so forth. So there's no limitation there, and all it requires is you to sort of push or do a little bit more research on your own. So integrating responsible investing strategies in the wealth management experience. So this is my job as an advisor or portfolio manager, wealth manager, however you want to define me. I mean, so what we're doing through this whole phase is we're going from discovery, analyzing, implementing, and monitoring, right? And so really what that is for me, you know, I'm looking at responsible investing as sort of a lens that I look at the entire perspective. And I'm going to come back to this, but I want to first share a quick story. So when I first started, I was working, you know, I'd go and speak to foundations, right? And a lot of the work I do is with a lot of not-for-profits. I do work with a lot of foundations and so forth on my institution side of my business. But when I was working with these foundations, I mean, they were doing some great stuff. They were giving money away, you know, to the causes that were aligned with their mission. But then you sort of back it up and you say, well, wait a second, you know, 3.5% is going out the door. The other, say, 96.5% that's invested is totally at odds with what you're doing. And I mean, if you're trying to look at how you're going to maximize your intended or social impact, well, you're sort of missing the boat here, because yeah, 3.5 is going out, but that other massive chunk, you know, it's invested in companies that are causing the problem, right? So, you know, that became the big thing for me. So, you know, when we kind of looked at this, we thought, okay, well, you have to look at responsible investing as a lens through everything you're doing, whether it's impact investing, mission-related investing, program-related investing. And I apologize, this is speaking to the same example with the foundation. It has to be viewed as a whole. And so the same thing goes when I work with private clients as well, where, you know, we're trying to figure out, okay, well, what's important to you? And this is the biggest challenge. It's you know, a lot of folks in the audience here tonight will say climate change is the most important thing to me, right? That's easy. We can talk about that, we can address that, but maybe there's more, right? And this requires a deeper dive discovery where we're trying to figure out, okay, well, what can you affect? What change can you affect with this wealth that you have, with your RSPs, with your TFSA, with whatever it may be, correct? And then you start thinking, you know, as you get to know the person, you say, well, what are you doing on a day-to-day basis? I mean, are you driving your car into work every day, or are you biking or so forth, right? So it's looking at all these things and how you operate your day-to-day and how you are trying to affect change, right? And so, you know, when we go through this discovery process, we're trying to find out what's important to you. And then through this whole process, ultimately at the end of the day, you know, we're trying to figure out, okay, well, how do we invest your money properly? How do we make sure it's done according to your needs? Well, that's when we start to do the assessment and the analysis, right? And so I wanted to just show you this information, because it sort of makes you realize that, you know, there's some inconsistency in the scoring and the information and the research and data out there currently, right? So this is an example of Tesla, where, you know, for instance, someone's like, oh, I want to be invested in, you know, this transition to electric vehicles and the electrification, right? And here you have Tesla that has multiple ratings on their ESG qualities that are very, very divergent, right? So it requires, so where I'm going with this is when we're sort of helping you invest your money to help you meet your needs, it's requiring a little bit more of a proprietary approach, right? Where, you know, we talk a lot about ESG, and when everyone thinks about ESG, it's I'm doing this great stuff for the environment, but really, you know, you potentially are missing the boat on stuff, right? And so, you know, for instance, if we were just using the FTSE sort of research here, we'd be sort of thinking, oh, well, geez, you know, Tesla's actually a really bad operator. Let's avoid investing in them, right? From an ESG standpoint or from, you know, a thematic standpoint. So it requires more of a proprietary approach where, when we're looking at companies, it's not necessarily just pulling up that ESG data and sort of looking at what's been provided to us. It requires a little bit more deeper dive and due diligence, right? And so this sort of goes back to what I was saying about, excuse me, about the requirement to sort of, really understand what it is you want to do and what sort of change you want to affect. To make sure that those companies, although they may have, they may not be ranked properly, they actually are achieving what it is you want to do, right? So at RBC Global Asset Management, I mean, what they've done, which I think is really cool and really leading in this sort of responsible investment space, is they've developed a more of a proprietary approach where they collect the data first, and then they go in and start questioning and talking to businesses and talking to the colleagues, the suppliers, the customers, look at what they're doing from an environmental standpoint with their own proprietary questionnaires, right? And through all this, we're able to come up with better solutions that make a whole lot of sense, where we're really making sure that your values and your missions are being reflected in there. So I thought that was important to share. But anyways, I'm going to leave it there. And I suppose if there's any questions now, happy to answer them. But we can also wait until the end of the presentation.
All good, no worries, John. Thanks so much. That was great. Really, really nice to do a bit of a deep dive. And just to let you know, I was able to share that report, so everyone should have access to that in chat. So definitely worth downloading that PDF, everybody. It's a great, even deeper dive into dispelling some of those myths, which are so important, right? Is that there's so many myths out there. So fake news, as we would say. So let's dispel that, and let's get our money into some of those funds. So I did have a few questions here. Let me pull them up. So I did have EcoFair Toronto. Want to welcome EcoFair Toronto. Thanks for putting on a great event. I attended a couple of your virtual events, so that was fun. Thanks for coming on to ours. So EcoFair Toronto is wondering how much of the increase in ESG funds due to demand by investors for such products versus the success of ESG companies.
So that in the chat, I didn't quite get that.
How much of the increase in ESG funds is due to the demand by investors for such products versus the actual success of the companies? It's
demand.
Mm-hmm.
It's definitely driven by demand right now. I mean, with everything that we've been through this pandemic, and it's funny, I held an event back in February on climate change and meeting clean tech, because in Ottawa we have a pretty robust clean technology sector, and at the time, obviously, climate change was huge. It was a big topic, right? And it hasn't gone anywhere. We still have serious issues that we need to address. And this group and this audience, I know, is well aware of that. So as this pandemic rolled out, as we saw crazy market volatility and turmoil, as people who had cash on the side, said, oh, I'm going to start investing, they started looking at these strategies, right? And so, when people are looking at responsible investing strategies, they just think ESG is where I need to go. And who does a really great job on this is this guy named John Cook, who runs this fund called Green Chip out of Toronto. And you can get it through another sort of mutual fund provider, but he talks about this at length, where it's just like, ESG doesn't mean you're addressing climate change, right? You got to be in that thematic space of doing it. But I think for most investors, what they're looking at is, I just want to do climate change. They don't necessarily do the due diligence or research into, the actual product that they're buying, and they just pile in, right? So I think it was a demand thing, and now most of the other asset managers are if they haven't already, are releasing ESG related funds, and some are doing more thematic stuff for sure.
Fantastic. I've got a couple others here, and I also want to just thank Heather personally for putting some links into chat there. She was sharing some links on the enterprising investor. So thanks so much, Heather. I know there's a great bit of conversation going there. So a couple other questions for John. We've got one from Jeff House, and he's wondering, are RI investors normally front-end loaded or based on return?
That's a good question. They all depend, right? So if you're That's more of a wealth management question, but essentially, if you're selling mutual funds, you have a couple of options, right? So if you're regulated by what's called MFDA, you can be front end loaded, meaning you potentially charge a fee off your services right off the bat, saying, oh, I'm going to charge you 1% for this, and then you get paid a trailer commission, I suppose, on any kind of mutual fund that you provide. So the RIA guys, most of the investors or the most provider, the RIA advisors or folks that are in this network, they're either MFDA or they're IROC or they're OSC. So I'm IROC licensed. So basically what that means, I'm a fee-based investment advisor or portfolio manager. So you're paying me a yearly fee of whatever it is. Normally it's based on assets under management. But we don't charge a commission up the front by any means. That doesn't happen.
Great. And I've also got Anatoly. He was just wondering, do you carry fiduciary responsibility? Yeah,
absolutely. Yeah, as a CFA charter holder, I'm a portfolio manager, so I am a fiduciary. I'm a fiduciary, approved investor, and basically you're my client, so everything has to be, in your best interest. So I think the question earlier about how can someone who's an advisor work for a bank? Well, it depends on where you're going. So if you're going into a retail bank, an RBC or something off the corner of the street, they're typically going to offer you an RBC Global Asset Management Mutual Fund. But as you kind of progress up, so if you're working with a financial planner at RBC or someone else that is more specific in investing, you probably will have the option potentially to buy other mutual funds. And then when you work with someone like myself, we have no obligation to sell you any RBC product by any means. We typically decide what's best for you based on your specific needs and objectives and go from there.
Oh, looks like I was mute there. Just to give you a heads up there, John, I did share your email into chat there. If anybody wants to get a hold of you, I'm sure you'd welcome a conversation and get things rolling for them and get them going in the right direction. So thanks so much to John. And I want to move over next to Aaron from CoRec and sorry, I keep saying that, CoRec and O Energy, right? No, OREC and Co-Energy. So I want to say a big thanks to Aaron as well for helping to gather some of the speakers. Aaron did a great job. I told him, hey, we're looking at doing some responsible investing, green drinks, and Aaron was able to step in valiantly and help us to corral Tina and John. So big thanks to Aaron. Aaron right now is the acting general manager of OREC and Co-Energy, and these organizations seek to mobilize community capital to realize local sustainability projects, such as deep energy retrofits and solar installations. Through these parallel co-ops, they have financed and developed 8.5 million in carbon emission abating projects in Ottawa and Eastern Ontario, so that's great. Aaron is responsible for project development, member and investor relations, day-to-day administration, and pretty much everything else over there, so that's great. I know he's an advocate, an avid bicyclist. He's probably still biking in this cold weather, and I want to give it over to you, Aaron, to share your screen and get going and talk about co-ops, because that's something we haven't really talked about, and how people can invest in co-ops and what they, to make a difference and what you guys are doing out there. So over to you, Aaron.
Thanks, Nick, and thanks very much, Tina and John, for really setting this scene and talking about, the bigger picture of what, sustainable and responsible investing is all about. So bear with me here while I get this queued up. Is everyone seeing that all right? And is everyone hearing me okay?
Looks good. Yeah, both good
Great.
to go there. Thanks so much, Aaron.
Fantastic. So yeah, folks, as really pleased to join you tonight. It's been a while since I haven't been to one of the virtual green drinks, but when they were at the pub, I was certainly make it out whenever I could. So I'm going to be, as Nick mentioned, talking to you about something a little different than what Tina and John were talking about, but of course, still tying the thread with the sort of social responsible investing. So. A little bit about the Ottawa Renewable Energy Cooperative, and this is an organization that I think some of you all may be familiar with. But OREC got its start back in 2010, and really it was developed to emulate some of the great work that had been accomplished through renewable energy cooperatives in parts of Europe, Denmark, Germany in particular. And really, as Nick mentioned in the preamble, it aims at connecting local investors with on the ground tangible projects. And for OREC, that meant solar projects. So with the introduction of the Green Energy Act and the feed-in tariff program in the province of Ontario, there was an opportunity for a unique kind of cooperative to play a role in financing and developing these projects. And that's how OREC got its start. Flash forward 10 years and we're 780 members strong. Those are all individuals living in Ottawa or Eastern Ontario. So it's a fairly local focus that we take. And our $8 million of solar projects are also in that same catchment area. So between between sort of the border with West Quebec and our furthest project is still well within the city of Ottawa, excuse me. So those solar assets that we've developed have the $8 million has come entirely from member investments. So that's individuals putting their capital forward and pooling. The co-op playing a pooling role to be able to develop these projects. And we're up to now 19 completed projects, and number 20 and 21 are well on their way. Actually, one was just connected to the grid a couple days ago, and these are a range in size and sort of scale, as well as the kinds of partners and host organizations that they're with. So we've had a really fruitful relationship with a couple of the school boards here in Ottawa. And we've done one project with the Federal Crown Court, and we've done a lot with other sort of businesses and housing providers along the way. It's just a quick, snapshot. As I say, a lot of variability in terms of size and type of project. So in the top left there, that's our project in Alfred, in the municipality of Alfred, just outside of Ottawa and to the east. And that's an interesting project. It was our first ground mount solar project. It was in partnership with the municipality as well as a First Nation partner who collaborated with us on that project. To the top right, that's her project with Kin Vineyards. So when you're drinking a bottle of local Kin cart wine, you can know that solar, while not directly powering the building, helped them offset some of their carbon footprint. And I know they were striving for net zero at a certain point in time. I'm not sure if they've achieved that, but our solar project helped them get a part of the way. The bottom left is one of our first large-scale projects. That's just on a storage facility in Dunrobin. And in the bottom right, that's with Samuel Genet Public School with the French Public School Board. This is one of those recent projects that I mentioned earlier. So this is the brand new, the Mère Bleu Collège Catholique. It's a high school under the French Catholic School Board in Orleans. There's an almost identical structure that was also erected in Statesville, the Paul Desmarais High School. And these two brand new schools were very promising sites for solar, and they were designed as such, actually. And so we were really thrilled to be able to continue to collaborate with the French Catholic School Board to be able to implement these projects. And these ones are really unique for OREC because they're developed through a 50-50 joint venture with the school board. So it's a really strong partnership that we have with them. Shifting gears slightly here, folks, to co-energy. So as Nick mentioned, there's two parallel twin, in many respects, twin organizations. But co-energy really is, I like to present it as sort of an OREC 2.0. It essentially less restricted in terms of the activities and services that it can provide for both the community as a whole, as well as the actual projects that it can take on. So co-energy established more recently in 2018, and that was really with the closing down of the feed-in tariff and Green Energy Act when the Ford government came into power. And we were looking at how we could continue, to build upon the success that OREC had experienced. As I say, a very high investment appetite from our membership, and no shortage of projects that needed to be taken on. But we also recognized that we wanted to amplify the especially the GHG reduction impact that we could have. And where that led us to was really to look beyond solar because, fortunately here in Ontario, we have a relatively clean, electricity grid. And so with co-energy, we're taking a look not only at solar and renewables, but also at conservation and energy efficiency. So we're kind of looking to take that model of community, cooperatively financed projects and apply it to the energy efficiency space. And part of the reason we also wanted to work in this space is because we've recognized that there's a bit of a dearth in service providers for the smaller scale institutions out there. I mean, a lot of the larger energy savings companies, your ESCOs, like, your Honeywell or your Siemens, they're going to focus on institutional groups like, colleges, universities, government facilities and things like this. With co-energy, we wanted to fill the gap that can service groups like nonprofits, recreational facilities, affordable housing facilities being a huge focus of ours. And again, just bring not only the capital to those projects that are so needed in terms of tackling, what can sometimes be very long payback energy efficiency projects, but also bring, expertise to the table. So when we take on projects with co-energy, we're not just financiers. We know that, that's a challenging market to enter into. We are looking to provide more of a turnkey, a holistic approach. So everything from, the seed of an idea with, a single board member with a nonprofit who wants their facility to reduce its carbon footprint, all the way through till, fruition and implementation. And so all these steps that you can see here are things that co-energy takes on with our clients. And we really like to position ourselves, as more of an energy partner, an energy savings partner with these organizations that we work with to help them, because this is a complex and long journey to sometimes take on these kinds of initiatives. And so we want to be there every step of the way. This is a real quick snapshot about, how it is that co-energy makes its revenues and how is it that we're able to repay our investors. Of course, that's a really important part of the puzzle, obviously. And I remember when I was presenting to Green Drinks over a year ago now, probably, I had this very question: is how do you actually make money from a member of the crowd? And it was something that was remiss in my presentation. So basically, this is a really oversimplified, snapshot, but essentially what we look to do is help places save money on their utility bills. And we really take a very tried and true method that is from the energy savings and energy conservation field, which is essentially a shared savings approach or a shared savings agreement. So, on the far left, column, you've got essentially the utility bills before we get to them. And then we look to reduce that energy bill. And the rate or the percentage at which we reduce that can, fall anywhere between a small, 20% decrease to anything, towards 50, 80. And we are working on some longer term projects that would maybe strive to hit net zero by implementing renewables as well. And from there, we're going to enter into, it depends on the nature of the project as well as the nature of the counterparty and the client. But generally speaking, we're going to enter into something that resembles like an equipment lease arrangement or some form of financial agreement that allows us to essentially recoup our upfront investment plus interest over time. And so essentially what we're doing for these folks is financing 100% of their upfront retrofit costs or renewable energy generation costs. And then we are leasing it to them, or we are recouping that cost over time. And the aim of our group, and what makes it appealing to a lot of nonprofits who really do want to take this kind of work on, is that we strive to make it cash flow positive from day one. So because all these measures have an inherent savings from, it's just, sometimes those can be hard to recoup because the payback comes after 8 or 10 years. For them, they can start saving from day one because they're, hanging on to 10, 15, 20, 25% of the energy savings, while the rest is coming back to co-energy. But still, from the get-go, without putting any money down there, they are reaping those savings. In terms of how we see ourselves fitting in, and Nick mentioned before, a lot of folks maybe jumped on the call, but within the context of the City of Ottawa, launching its very ambitious energy evolution program, we do see ourselves as playing a really important role in that kind of achieving those targets. And for us, it's how do we mobilize that patient, community capital towards these kinds of on the ground projects. In that energy evolution project, the City of Ottawa laid out that they are targeting 150 megawatt installed solar between now and 2025. And when you think of the price tag associated with that, that's going to be ample. So we're going to need to find sources of funding from all levels of government, as well as private and we hope community sources as well. And so that's what really drives us is a inherent belief that 100% of a clean energy or low carbon future is attainable, and we can play an important role in achieving that. A little bit about the cooperative model for folks who aren't familiar with it. Cooperatives are businesses, but they are driven by different motivations. A lot of them are nonprofit. Our cooperatives are both actually for-profit because we issue investment products, and that's part of the Cooperative Act. But cooperatives are really, democratically run, member-driven organizations. There's a little blip on the sort of in the media cycle around co-ops when the Mountain Co-op sort of shed its title as a cooperative. That was a sad day for a lot of us in the co-op world, but inherently, they are organizations that strive to serve their membership, and they do so in whatever way they sort of set out. So a worker cooperative seeks to serve its membership by creating employment for its workers. A purchasing cooperative serves to serve its members by purchasing goods or services in a bulk or unified manner. So for us, we are a little bit different. We're a renewable energy cooperative on the OREC side. On the co-energy side, we're not as tethered by that. Essentially, our raison d'etre is to develop, finance, and in some instances own and operate renewable energy and energy efficiency assets. We think there's a really important role for cooperatives to play in this, and the sort of inherent democratic nature of them, we think, makes it a strong candidate for playing a role as we transition to a low carbon future. So a little bit more about the actual investing in OREC and co-energy, and I'm not, just based on the regulations that guide us, I can't speak about the specific of our investment products right now because we aren't actually offering any, but I can speak more generally about what we've done in the past. So as I mentioned with OREC, it's a proven model. Over that $8 million has been raised over the course of about a 10-year period, but throughout 6 investment offerings. So we've raised that in the form of by selling either preference shares or investment notes. So a share is 20-year term, and it has an annual dividend based on the performance of OREC's portfolio. Investment notes are more like a bond or a debt-based instrument, and they provide an annual interest rate. So we've sort of used both of these products to be able to develop our projects in a way to ensure that we're not over leveraged or anything like that. And with co-energy, we've sought to emulate that. So we've only just gotten one small offering under our belts with co-energy to finance mostly LED lighting retrofits with a couple different nonprofits around the city. But essentially, we're looking to mobilize that same kind of preference share model to be able to allow folks to, as I say, directly put their money behind these projects. These are products that we design ourselves. They're obviously very different than maybe some of the products that John and Tina and Mark are going to speak to, because they're not publicly traded. These are issued by the co-op, and they can only held within certain, they can be held independently, sort of unregistered, or they can be held within a registered account such as RSP or TFSAs. But even there, only specific institutions are sort of eligible to hold them. And so, you won't see us listed on any of the public lists. But what we do think is that we sort of provide an interesting option, especially for the self-directed investor out there, to be able to put their money in line with their values. Beyond, the kind of inherent environmental targets that co-energy has, I think, our co-energy and OREC have, we strive to achieve a couple other things. And as I said, with co-ops, they have this, inherent democratic function. where it's a one member, one vote system, regardless of whether, how much you have invested in the cooperative or if you've invested at all. So we really like to think of that as sort of an energy democracy lens, through an energy democracy lens. And inherently, we know, all of us on this call know that as we combat climate change, as we shift to a low carbon or a zero carbon future, there's going to be beneficiaries of that transition. And our feeling is that those benefits should be spread as wide as possible. And so that's where we think the cooperative, model sort of lends itself well. Beyond that, we also look to sort of really, as I mentioned, take a really local focus in the kinds of projects that we develop. And so in that, we try to sort of support a circular economy because we've got local members investing in local projects, earning returns that they can then, reinvest into other, local institutions or businesses or spend their money within the community. So this is a snapshot here of some of the number crunching that we did back in 2017. And I'm, ashamed to say that we have not crunched the numbers since, partly just due to capacity issues, but, we funnel all, 98% of capital, going towards our projects, and we look to, hire local labor and source locally when possible. Of course, China has made that a very challenging thing to do with their solar industry just taking off. But so a little bit of a snapshot, as I say, outdated of what we try to accomplish. Again, beyond the economics of it, especially with co-energy, we're really striving to amplify the social impact that we have as well with our projects. And, when you're talking about investing in affordable housing facilities or nonprofit recreational facilities, what you're helping them do, ultimately is lower their operating costs. And that gives them more capacity and more funding to dedicate towards their core mandate. And that's really important to us. And I think it's really important to our members as well. Alongside that, when you're talking about affordable housing, and I keep coming back to that example because it is a real focus of ours, you're also, helping with increased tenant comfort or increase, occupancy comfort. And that can extend into the commercial sector as well, where you've got a lot of studies showing that energy efficient workspaces result in more productive and workspaces as well. So that goes alongside the other co-benefits that we all, I think, talk a lot about when we talk about combating climate change, things related to accessibility of facilities, as I said, productivity, the opportunity for educational resources to be created out of them. And another one that I mentioned here is about driving demand. And I think this is something that we maybe overlook a lot in the conversations about a broader, societal shift towards combating climate change. And part of what we're trying to think about at co-energy especially is how do we support and allow the growth of our local workforce when we're talking about pushing HVAC contractors to be more comfortable installing heat pumps rather than a traditional air conditioning system, or when we're talking with electricians about how to become more well versed with installing electric vehicle chargers. I think this is a really big part of our society as a whole needing to scale up and tool up our workforce to be able to meet the demand that is coming. As I say, just as an example, 150 megawatts of solar in 5 years, that's going to take a huge workforce. You think of the even larger targets set with things like building energy efficiency and stuff like that. The task is daunting. Just as I close, this is a little off in left field, but I wanted to mention it just because I think it's important to. There are some rumblings from the provincial government about regulatory changes that could open the doors, a lot more towards how solar, in particular, and distributed renewable energy generation assets can play a role in our transition to a clean energy future. So just wanted to mention for folks who are interested in the policy side of things, it's open for proposals and for feedback right now from the Environmental Registry of Ontario. This would essentially allow, solar generation to happen in one place and offset consumption in another. So, very much in line with what we've seen in terms of programs in many jurisdictions in the United States and elsewhere, and frustrating that Ontario is just getting around to it now, but baby steps. So that's all for me. I saw my chat thing like going off like crazy. So if there are questions,
yeah, that's it. You were inspiring a lot of great conversation. A few people sharing some great nuggets there. I also was able to share the OREC and the Co-Energy websites there with everybody, Aaron. And there's contact forms on there, so they can reach out directly to you through those forms. We do have a couple questions, if you're okay for that.
Of course. Yeah.
Jeff Howes is wondering, is Co-Energy currently working with City of Ottawa on any projects?
So we're not working in an official capacity, Jeff, but we have been chatting with them about, how can we bring, our expertise and our funding to the table. So we have been chatting with them a little bit around that solar target that I mentioned, and a lot of that discussion back and forth is obviously about proper procurement and stuff like that. So early stages right now.
That's great. And you may have already answered a bit of this, but Mary Ellen earlier on in your talk was wondering, are these solar panels manufactured from scratch in Canada? If not, what is the Canadian content that you have in there? I think you talked a bit about that.
Yeah, it's a great question. They're not from scratch, they're not manufactured from scratch in Canada as much anymore. I know in our first, I want to say 5 or maybe 6 or 7 projects with OREC on the solar side, those were Canadian source content. Of course, as many folks may remember, the Ontario government actually got slapped with some really significant threats or concerns from the World Trade Organization over protectionism, because there was stipulations in their procurement through for the feed-in tariff project that there were stipulations about local sourcing, and that kind of ran against some of the free trade agreements that Canada had signed on to. So that was an interesting dilemma. But ultimately, since about the mid 2010s, it's been really challenging to source locally. It's not to say there aren't local manufacturers of solar, but it's a really tough market to compete with when you see the pricing coming out of the Chinese manufacturers. So
yeah, still a bit of a challenge there, but great to hear about some of the work that you're doing there, Aaron, and really proud to have seen you basically from the start of your role there and really blossom out into your acting general manager. So best of luck moving forward. We definitely hope that people support you, and we'll just get you to stop share when you get a chance there. Perfect. And want to bring up our last speaker, and we will have this one's going to be a bit of an interactive session, so everybody can maybe do a bit of a stretch, get rolling, get ready, because I'm hearing that this will be quite the session. So I want to bring in Mark Goldgrub, and he's one of our SmartNet Alliance's newest members, and he is a lawyer over at the Green Economy Law Professional Corporation. It's a boutique Toronto-based corporate and commercial law firm that focuses primarily on work with green companies and entrepreneurs. He is licensed to practice law in Ontario and New York, and regularly writes about sustainable finance matters for the firm's blog and newsletter, and I'll post a link shortly there. So over to Mark for your our last talk and a bit of an interactive session.
Hey everybody, I know it's been a little bit long, but this is going to be fun, even though we're going into the law. But this is going to be fun. Okay, so before we get started, just a little disclaimer that nothing I say here is legal or financial advice or recommendation to buy, sell, or hold any securities. It's for educational purposes only. And please consult a licensed legal or financial professional if you would like advice regarding investment securities or other legal or financial matters. As Nick said, my name is Mark Goldgrub. I'm a lawyer at Green Economy Law Professional Corporation. I'm licensed to practice law in Ontario and New York. And when I was in New York, I actually, I went to law school in New York and actually interned on Wall Street for a bit. So I've been paying attention to the financial side of climate for a long time, and in terms of where climate meets finance. And if you're interested in my work, if you're interested in keeping up with the news on this or getting ongoing commentary about these things, you can go to my website. You can sign up for the newsletter, the link I just put in the chat, and it's once a month. And I try and cover some of the biggest, most important stories happening around this area of law. So I don't want to retread too much of the stuff that John and Tina talked about. Let's just basically, we all understand that there's individual stocks and then there's funds. There are mutual funds, exchange traded funds, also known as ETFs, hedge funds, all kinds of funds. And the main reason people put their money in a fund, usually it's because the fund is managed by investment professionals. With ETFs, it's maybe a little bit less management than some other funds, but they put it basically in it's like a basket of stocks. And they say, I just am interested in this, you know, here you guys, here's my money, and please give me more. The downside of investing as funds is you're not in control of your own money. And traditionally, funds skew conservative. And when I say conservative, I don't necessarily mean political. I mean, they're trying to avoid volatility. They're trying to put your money in a place where even if maybe they're not going to make you that much money if things go bad, but they definitely don't want to lose you money, or else they're going to have angry customers. So funds skew conservative, but that translates in this day and age into politically conservative, because in finance, investing in energy, and by that I mean fossil fuel companies, is a huge part of traditional finance. And there's a big problem we're having right now, which is the financial community is not beyond that. They haven't moved past that. It's still a bedrock of traditional finance. And this is a bit of a problem, as you hopefully all know. ESG investing is kind of a new hot thing. Everybody's really into it. Tina and John talked about it. I want to explain this a little bit more because I'm not sure everybody totally understands every aspect of this. So environment actually doesn't really mean Tesla and Beyond Meat. Actually, it really means more like just not investing in Exxon. That's really what the ESG part is kind of looking at. Social is probably things around like diversity, and governance is actually about what is really employees, how well are employees treated? Are employees represented by a seat on the board of directors? So ESG funds typically avoid companies with bad ESG ratings. Tina talked about this a little bit. It's about exclusion. ESG is not about buying good things. It's about avoiding bad things. And ESG ratings are not a perfect science. As John mentioned, there's a lot of different ratings agencies, and different ratings agencies have different metrics for what they consider a good ESG company or a good ESG fund. So, and they disagree with each other. Somebody might say this is good, somebody might say this is bad, and there's no universal one. And this is a bit of a problem. I'm going to talk a little bit about more about some of the kind of the legal side of that and what's happening with that a little further down. But to reiterate a point that's already come up a number of times, you may want to look at a fund's holdings before investing in it. Now, let me give you a great example here. This is Ishares. Ishares is a subsidiary of BlackRock, which is the largest assets holder in the world. It has ESG in the name of the fund, so you know it's an ESG fund. MSCI, that's Morgan Stanley Capital International. It's actually no longer part of Morgan Stanley. They spun it off, but that's where it came from. And that's the rating agency that said, this is an ESG ETF. An ETF, it's a basket of funds. It's traded on the stock market. That's the exchange part. It's traded on the stock market like a stock. You buy an ETF, you basically buy like a stock in an ETF, the way you buy a stock in any other company. But let's look at the holdings. Did you notice anything odd in the holdings? This is an ESG ETF, and you got Enbridge and TransCanada here, the company behind the Keystone Pipeline. If you're buying an ESG ETF, are you thinking you're going to be buying TransCanada and Enbridge? I would imagine probably not. So again, we're not in a good place right now for ESG. So we're going to play a little game. We're going to play a little game here called What's in That ETF? So I'm going to show you an ETF, and you're going to judge based on the name of the ETF what you think is in the ETF, and you can write your guesses in the comments here. So let's start off with the Vegan Climate ETF. For those of you who don't know, I'm vegan. I've been vegan for 9 years. My friends probably think this is the ETF that I dreamt up. It is not. This is a real ETF. And so now I'm going to give you about like maybe 5 seconds. McDonald's. I'm going to give you like maybe 5 seconds, 10 seconds to guess what companies you think are in here. I'm looking at the chat. Okay, people aren't really guessing much. All right, somebody throw Beyond Meat. That's a good guess. I mean, at least you would think it's a good guess. A lot. Okay, Beyond Meat is, all right. So let's actually look at what's in this ETF. It is Apple, Microsoft, Facebook, Visa, Verizon. Doesn't, does this really, is this really so vegan, so vegan, much climate? I don't really think so. I don't really think so. But the point is that they're avoiding companies that kill animals and that are bad for the planet, and they end up mostly investing in tech and telecom. So, all right, let's do another one. Do you guys want to guess what's in the BMO Balanced ESG ETF? Don't Google it. Don't cheat. All right, you got a couple seconds to make some guesses. Throw them out. Throw out your guesses, everybody. What do we got? That's funny, Peter. Banks, BMO. All right, here's the answer. The answer is more ESG ETFs. So this is an ETF that took this philosophy. We heard you guys really liked ESG ETFs, so we made you an ESG ETF out of other ESG ETFs. One last one. Okay, everybody. Ishares Global Clean Energy ETF. What do you guys think's in this one? You got a couple seconds. Throw them out there, guys. I'm looking at the chat. Throw them out there. Oh, now you guys are cynical. You guys have gotten really cynical. Okay, actually, this one's not so bad. These are actually real clean energy companies. Now, but to know that, you would actually have to look at every single one of these companies. You would have to Google, what does Verbund AG do? What do they do? You'd have to actually Google all these companies. Now, I did Google all these companies. These actually are pretty much, generally speaking, they're clean energy companies. One of them has a little bit of involvement with natural gas, but that's kind of the worst offender. So this one was not bad. This one was actually not bad. But the point is you have to actually do the research, which other people have said tonight. I just wanted to have a little bit more fun with it and give you guys kind of more concrete examples. So let's, so yeah, basically it's not so easy. You actually got to do some work here. You can't just buy something that has ETF in the title and assume it's good. Now let's talk law, everybody, or we're getting to talking some law. So at this year's World Economic Forum in Davos, so when you hear about this Trump in Davos, this person in Davos, that person in Davos, they're there for the World Economic Forum, and they put together a document titled Measuring Stakeholder Capitalism. So there's been a kind of intellectual debate over the last couple of years about stakeholder capitalism versus shareholder capitalism. The difference is it really comes down to this idea that in American law, and we're specifically talking about Delaware corporate law, the primary duty of a corporation is to serve the interest of its shareholders. There are some people who say, no, that is a problem. They should be serving stakeholders. That's the community, that's their employees, that's their debt holders, the environment. In Canada, in Canadian law, we actually have stakeholder capitalism. But actually, this is a bit of a misleading title, because really what this document was about was creating a single set of ESG metrics. Bloomberg called it the biggest step to rally companies, regulators, standard settings around a single set. Now, the World Economic Forum didn't create some kind of legal rule about this is now the ESG standards for everybody. But what they said was, with their influence, they said, this is what we're recommending everybody adopt. This is how we look at it. We think this is a good way to measure ESG. And we recommend that everybody basically apply our recommendations. So like I said, that's not law, but the EU is looking into setting standards for a legal definition of ESG. The American SEC at this time is not. We're going to talk a little bit more about that later. In Canada, we haven't really moved on this, but that's not super surprising considering America hasn't. And I think that that could change. We're going to talk more about this in a second. So this is an interesting thing that happened recently. On June 23rd, the US Department of Labor proposed regulations prohibiting pensions. This is actually private industry pensions. It's a specific kind of pension, not every pension on earth or in America, but prohibiting private industry pensions from investing in ESG vehicles, so funds, if doing so, or funds largely, if doing so would prioritize non-financial objectives. Basically, if you're going to invest in ESG, but that's not the most profitable thing to do, you're going to get in trouble. Now, they The U.S. Department of Labor proposed these regulations within the framework of the Employment Retirement Income Securities Act. So just so anybody knows, in case anybody's not super clear, regulations, a lot of politicians like to hold up regulations as a punching bag, but really when we legally talk about regulations, we're talking about places in law where the law says the agency is going to figure out the technical points on this. And that's what the Department of Labor did here. They basically put forward these regulations. They proposed them saying that you can't invest, if you're a private industry pension fund, you can't invest in ESG vehicles if it would prioritize the environment or society above your shareholders. And beneficiaries can sue under the act. If you, not every act allows what is called a private right of action. There's a lot of law which can only be enforced by the government. This law, ERISA, is not that. If you actually are part of this, a fund that's governed under this, you can sue for violations of the law. Now, more than 130 fund management advisory firms, including BlackRock, which has made a big public commitment to sustainability. Their actions are not, I would say, living up to that as much as maybe I would like, but they all wrote letters opposing the plan. They basically said, you're causing problems here. It doesn't make sense. We care about our beneficiaries just as much as anyone, and you're trying to make life difficult for us. Now, why would the Department of Labor want to do this? Well, some people say maybe it has to do a little bit with the fact that the Department of Labor is part of the executive branch, and that's basically the Trump administration. And the Trump administration is very closely aligned with fossil fuel companies. It might be a problem if they're seeing a lot of pension funds saying, we're going to invest in funds that cut you guys out. That's not good for the fossil fuel companies. So some people say this was really a political move to help fossil fuel companies. Now, the proposed regulations were submitted to the White House in mid-October. So this was only 4 months after their proposals. They were first proposed. The agency said, here's some regulations we're thinking about implementing. And then the regulations go through what's called notice and comment. They present them to the public, and the public, including companies, can weigh in and say, keep this, lose that, change this, make it a little better. That's how it works. That's part of the legal process. Now, the rule changes with significant impact like this, from what I have read, typically go through 18 months of notice and comment. It's not a short period. Now, the Department of Labor submitted these to the White House after 4 months. They basically said, all right, 4 months, we're good. I think we figured this one out. This could be problematic because the law could be struck down under the Administrative Procedures Act for bad process. And here's the part of the law that would basically play the leading role here. This is section 706. And what it does is allows a court to hold unlawful and set aside agency action that includes creating regulations. Findings and conclusions found to be arbitrary, capricious, and abuse of discretion or otherwise not in accordance with the law. If you're putting out a bunch of regulations and it looks like there's a reason for these regulations aside from the fact that you think it's actually what's best for the public, and you're rushing them through the notice and comment period, well, there could be a good argument that these regulations are arbitrary, capricious, and abuse of discretion and otherwise not in accordance with the law. So those regulations could be struck down. Now, maybe this doesn't actually matter at all because you may have heard this interesting news tidbit that the US is going to be getting a new president. So under a Biden administration, they can just say, actually, we're going to reverse those regulations, or if they're in court, they cannot defend them. So at this point, those regulations probably are not going to become the law. But it's interesting to know that governments can do this. They can change laws to try and affect the markets in interesting and sometimes obscure ways. Biden does not need Congress to reverse the Department of Labor rules. He also does not need Congress to order the Securities Exchange Commission to set ESG standards or adopt climate-related risk disclosure requirements. These are things that a lot of people are talking about, especially the climate-related risk disclosure requirements. I have heard this come up a number of times in the last week. A lot of people think this is going to happen, that they're going to tell the SEC, tell large companies and institutional investors, you have to disclose climate-related risks. What are you investing in? Is it going to be affected by climate change? This is a really big deal. I'll also note that Britain, the UK, on Monday said they're doing this. They said in 2025, everyone's going to have to do this. And I think this is a really big deal because right now, as I mentioned earlier, the financial industry is very conservative. They are not thinking about climate change day in and day out when they're investing in stuff. A lot of it is, I don't want to piss off my customers. I need to make sure we're keeping good returns, investing in safe things. If I pull out of oil, it's going to ruffle a lot of feathers. I'd rather not. But if they are looking at climate-related risk disclosures every day, and they're seeing climate change over and over, and customers and investors are reading about this, that could have a big impact in shifting the mentality. So these rules, they're kind of subtle. Really, they're not a Green New Deal. At least these rules aren't. But what they could do is have kind of interesting impacts that are not as obvious to everybody. And if that happens, it's not unlikely that Canada would follow suit. Then there would be a lot of kind of cover for Canada. And really, we're talking about the provinces, because in Canada, we don't have a national securities regulator. We have provincial securities regulators with kind of an interesting sort of coordinating body in the federal government. But they could basically start to look at following the US's lead if they move in that direction, which there's a lot of people thinking that they will. So to conclude, just wrap everything up, ESG rules not well defined yet. This could change in the future. Until then and after, look at the holdings. Make sure you know what you're actually investing in. Maybe you have to Google every company that's in there, but that's how you know what you're actually investing in. Governments can help or hinder ESG investing through agency regulatory rules. They can change the rules, and these little rules can have a big impact. And climate-related risk disclosure could deeply affect the financial industry perspectives with respect to sustainable investing. That is all. This has been a presentation by Green Economy Law. And just in case anybody doesn't know, I actually kind of skipped this ahead. If somebody, maybe a lot of people aren't 100% sure what I do. I'm a corporate and commercial law firm for the Green Economy. So I work with companies that are green companies and help them with corporate legal matters. So that could be incorporation, contracts, employment, etc. I'm not an environmental lawyer. A lot of people make that mistake. Work with companies.
Awesome.
All right.
Thanks so much, Mark. Great presentation. Really really good to dive deep and see what's actually in those funds, right? It's sort of like making sausage, I guess, and we'll be glued to see what Biden does. I'm sure it'll be quite a few executive orders coming through, so be interesting to see how that all shakes up. I did have one question for you from Heather. She's saying she's surprised none of these ESG funds have a high percentage of B Corps. Why not?
Well, for one, I chose some funds that maybe exemplified problems with ESG ratings. So that could be one reason that they didn't have a lot of B Corps. Also, a big problem is that there aren't that many large publicly traded B Corps. There are some, and some very notable ones. I'm wearing clothing by one right now. I think Patagonia is publicly traded, right? Anyways, but it's not a huge thing across the industry. And even companies with high ESG scores like a Microsoft or other tech companies, and some of them are doing great things on climate, but a lot of them are not B Corps for a number of reasons. I did a presentation on B Corps recently where I kind of got into it. Here would be a whole nother presentation. So I'll just say, if anybody's curious about that and wants to talk to me more about it, they can email me at my email, which I am putting in the chat right now.
That's great, Mark. Yeah, well, maybe that might be another Green Drinks edition for one of our future editions. So people will have to stay tuned, but I know you love to talk about it, so people should definitely reach out to you and chat about that. I had a couple other questions that we didn't get to in chat that I can go out to all the presenters, whoever wants to tackle them. So Jeff House just had a general question: is RI, RRSP, and TFSA eligible? Anybody can tackle that?
What is RI? I'm assuming that's responsible investing. I answered him. Yeah, no, you don't have, there's no limitation on what kind of account you have, whether it's a TFSA, an RSP, a non-registered account. You can implement responsible investing strategies across all accounts, right? With some private investments, so I know with Aaron's, with the OREC and Co-Energy stuff, I know they were there's some limitations on where you can invest there. I know you can put them in TFSA and RSP. Is that right, Aaron?
Correct,
and
yeah.
other sort of other kind of vehicles like this as well.
Great. And I also had one from Roderick earlier on. He's wondering, what are the real rates of return after fees and everything? And how does that compare to exchange traded funds, ETFs? Maybe a word on fees and the...
Yeah, sure. I mean, mutual funds will typically have a higher fee. Exchange traded funds will have a lower fee. That's a big difference between the two. Real rates of returns really depends on the specific fund or vehicle that you purchase.
Perfect. We'll stick around for a little bit of a discussion, but I want to end the formal part of the night now and thank everybody. Thanks so much, and we'll put a pause on the recording and get that out on our YouTube channel. I did post a link to that to people to subscribe if they want to get their hands on it. Usually I edit it and turn it around in about a week or 10 days, and we do have our other virtual green drinks up on there. So roughly about probably about 8 hours of viewing now. So it could be a full day for everybody for those rainy, cold days coming up. So